We are witnessing an unprecedented collapse in the U.S. mortgage market. Mortgage applications have plummeted by 63% from their pandemic peak, signaling a severe decline in homebuyer demand. Despite recent Federal Reserve interest rate cuts, mortgage rates have surged to 7.2%, exacerbating affordability challenges. Home prices remain at historically high levels, with the median list price declining year over year in about 50% of states, yet still reflecting the largest housing bubble in U.S. history. This confluence of factors suggests that the housing market is poised for significant upheaval, with potential implications for homeowners, buyers, and the broader economy. If you find this analysis insightful, please like, share, and subscribe to Economy Explorer, and make sure not to skip any part of this video. Economic indicators influencing the housing market. In early 2025, the U.S. housing market finds itself at a critical juncture, shaped by a delicate interplay of key economic factors. Rising mortgage rates, persistent inflation, and constrained housing supply are redefining affordability, creating challenges for buyers and reshaping strategies for sellers. Each of these elements plays a role in a larger economic narrative, where shifts in one area often ripple through the rest of the market. Understanding how these factors converge is crucial for anyone navigating the housing landscape this year, whether buying their first home, investing in real estate, or simply trying to make sense of the shifting dynamics. This interconnected reality becomes particularly evident when examining the impact of mortgage rates, a cornerstone of housing affordability, on the broader economic environment. Let's explore how these rates, alongside inflation and other critical indicators, are influencing today's market trends and what they mean for those looking to make pivotal financial decisions. Mortgage rates and their impact. The story of housing in 2025 begins with mortgage rates, a crucial factor that has rippled through every corner of the market. As of January, the 30-year fixed mortgage rate has surged to approximately 7.09%, the highest in 8 months. This significant rise has tightened the grip on affordability for countless buyers, directly increasing monthly payments and pushing many households to reconsider their plans. Despite the Federal Reserve implementing rate cuts to provide relief, mortgage rates remain stubbornly high due to rising Treasury yields and lingering inflation concerns. This disconnection between monetary policy and market behavior reveals the intricate challenges buyers face, making affordability a growing concern. Inflation and housing affordability. However, mortgage rates are only one piece of the affordability puzzle. Inflation continues to erode purchasing power, adding strain to an already stretched market. With the Consumer Price Index climbing to 2.9% in December 2024, up from 2.7% in November, even incremental increases chip away at consumers' ability to afford homes. Compounding this issue is a housing shortage that amplifies competition, sustaining elevated prices. As limited inventory intersects with strong demand, home buyers find themselves squeezed on all sides. Higher costs of living and limited availability of properties have created significant barriers, particularly for first-time buyers. Employment trends and wage growth. While inflation and mortgage rates weigh heavily, the labor market provides a glimmer of resilience. Job openings have climbed from 7.7 million in mid-2024 to 8 million by August, signaling continued economic strength. Wage growth, estimated at 4% annually, offers some relief to workers facing rising costs. However, this increase remains insufficient to fully offset the growing expenses associated with housing. The delicate balance between job stability, income growth, and affordability highlights the intricate relationship between the broader economy and the housing market. Federal fiscal policies and market sentiment. The backdrop of federal fiscal policies further adds to the uncertainty. Concerns over rising budget deficits have heightened market volatility, pushing bond yields higher and indirectly influencing mortgage rates. For investors, this has created a cautious atmosphere where questions about long-term economic stability loom large. This ripple effect impacts not only those purchasing homes, but also those financing new developments, adding another layer of complexity to an already volatile market. Housing inventory levels. Even as economic factors present challenges, housing inventory remains tight, with just 3.1 months supply, a clear indication of a seller's market. This scarcity continues to sustain high home prices, despite rising borrowing costs. For many buyers, this means fewer options and greater competition, forcing difficult decisions as they navigate one of the most constrained housing markets in recent history. Consumer confidence and market outlook. Adding to the complexity, consumer confidence fluctuates as buyers weigh the challenges of current conditions against the hope for future improvements. Some remain optimistic, believing opportunities will emerge as the market stabilizes, while others take a wait-and-see approach. This sentiment directly shapes market dynamics as buyer hesitation and pricing trends interact in real time. By following these interconnected threads, mortgage rates, inflation, employment, fiscal policy, inventory, and confidence, it's clear that the U.S. housing market is at a critical crossroads. Understanding these elements is essential for navigating the unique challenges and opportunities that define 2025. Regional variations in the housing market. The impact of LA's wildfires, a destructive force in the West. Imagine waking up to a smoky horizon in Los Angeles, where wildfires have ravaged neighborhoods, leaving behind a stark reality for residents and the housing market alike. In 2025, LA's historic wildfires have disrupted the real estate market in profound ways. Entire communities have been displaced, and with thousands of homes destroyed or rendered uninhabitable, demand for temporary housing has surged. This has pushed rents upward while simultaneously limiting inventory for potential buyers. The wildfires have also led to rising insurance premiums, further straining affordability in a region already notorious for high costs. Home buyers are now prioritizing areas with lower wildfire risk, creating shifts in demand across Southern California. This environmental crisis is reshaping the Pacific Coast market, but to fully grasp its impact, we must explore the regional stories unfolding nationwide. The Midwest, a resilient heartland. In stark contrast to LA's turmoil, the Midwest offers a narrative of stability and opportunity. Picture a young family relocating to Columbus, Ohio, drawn by its affordable housing and thriving job market. With a median home price of $250,000, well below the national average, the Midwest is becoming a haven for first-time buyers and remote workers. Its industries, from manufacturing to healthcare, provide steady employment, anchoring the region's housing market. However, rising interest in these affordable markets has led to increased competition, tightening inventory in cities like Indianapolis and St. Louis. This steady growth raises an intriguing question. Can the Midwest maintain its balance of affordability and accessibility as demand surges? The Sun Belt. Growth meets growing pains. For years, the Sun Belt has been a symbol of economic prosperity and population growth. Imagine moving to Phoenix for its sunny climate and dynamic job market, only to face skyrocketing home prices and cooling rental markets. In 2025, cities like Austin and Tampa are experiencing shifts. Austin, for instance, has seen rents decline by 16% year over year as rapid development leads to oversupply. While the Sun Belt remains a migration hotspot, Challenges such as rising insurance costs from natural disasters and higher mortgage rates are tempering its rapid expansion. This evolving dynamic raises the question, how will these booming markets sustain their appeal in the face of mounting pressures? The Northeast, a revival in smaller cities. The Northeast, known for its dense urban centers, is witnessing a resurgence in its smaller cities. Think of Buffalo, where revitalization efforts have turned vacant properties into thriving green neighborhoods. With buyers priced out of cities like Boston and New York, places like Providence and Hartford are experiencing increased demand. These areas balance affordability with proximity to major metros, creating a unique appeal. However, aging infrastructure and high property taxes remain obstacles. Will these challenges slow the momentum of smaller cities, or will innovation and affordability drive sustained growth? To understand this, we look westward to a region known for its contrasts. The Pacific Coast, contrasting realities. The Pacific Coast tells a tale of dualities. In San Francisco, an out-migration wave has softened home prices, while in Los Angeles, the impacts of wildfires and limited inventory have kept demand high. Meanwhile, cities like San Diego thrive on international investment, maintaining competitive markets despite broader challenges. Seattle, another Pacific jewel, balances a booming tech industry with affordability issues, pushing residents toward alternatives like Portland. This divergence highlights the Pacific Coast's adaptability in the face of environmental and economic pressures, but how it evolves will depend on how it addresses its housing and climate challenges. From the destruction wrought by LA's wildfires to the steady growth of the Midwest, each region's story is shaped by unique forces. These variations underscore the complexities of the U.S. housing market in 2025, leaving us to wonder, what regional trends will emerge next? Projections for the U.S. housing market in 2025. Imagine standing in a suburban neighborhood, watching a moving truck arrive as a new family begins a chapter in their dream home. While individual moments like this bring optimism, the national housing market tells a more nuanced story for 2025. Experts predict a modest 9% increase in home sales, a small but encouraging recovery after years of sluggish activity. This uptick is driven by improving affordability in certain areas and an increase in inventory as sellers adjust their pricing strategies. However, this progress is far from uniform. Regions like the Midwest and parts of the Northeast are leading the charge, while high-cost coastal areas continue to grapple with limited inventory and high prices. One of the most defining aspects of 2025 is the return to moderation in home prices. Imagine visiting a property that would have been wildly overpriced a year ago, only to find its value has stabilized. Nationwide, home prices are projected to grow by just 2.6%, marking a significant shift from the aggressive increases of recent years. This change reflects a balancing act between sellers lowering expectations and buyers cautiously re-entering the market. Yet, in cities where demand remains high and supply constrained, affordability challenges still loom large. For many buyers, the weight of mortgage rates will continue to be a deciding factor in their ability to purchase. Picture a first-time buyer, eyes glued to the fluctuating rates, hoping for relief. In 2025, the 30-year fixed mortgage rate is expected to hover between 6.5% and 7%. While this represents a slight improvement from 2024, it's still a high threshold for many households. Even small declines in rates are unlikely to offset broader affordability issues, especially in markets where prices remain elevated. The complex interplay between interest rates and local price trends will shape much of the market's movement. Regional dynamics will also play a crucial role in defining 2025. Imagine the thriving housing markets of Texas and Florida, contrasting with the challenges facing California's Bay Area. where outmigration and natural disasters like LA's wildfires have left their mark. These regional disparities highlight the varying impacts of economic growth, population shifts, and climate considerations. Buyers are flocking to regions with strong job opportunities and affordability, while areas grappling with environmental risks and high costs see slower recovery. As we navigate 2025, the housing market reveals itself as a story of resilience and recalibration. The journey ahead is uncertain, but understanding these projections allows buyers, sellers, and investors to make informed decisions in an ever-changing landscape. If you've found value in this analysis, don't forget to like, comment, and subscribe to Economy Explorer. Thank you for being part of our journey. Watch one of the suggested videos for more insights, and together, let's explore the economy, one trend at a time.